Risk of fast money versus slow money. ¿Cómo están, you guys? Welcome to another episode of Tony Miranda, Simple Investing and Finance. Today I want to go ahead and talk about is what is better, index or individual stocks, and what would be the best option in terms of less risk. So before we actually go ahead and jump into it, let's go ahead and define what is a stock. First, foremost, what a stock is, let's imagine, for example, let's use an example for a cookie store. So let's say you happen to have a cookie store that's very successful, and there's a lot of cookies that are very high demand because there's no other store anywhere like it. And you want to go ahead and expand. Of course, everybody wants to grow their business or expand, and you want to go ahead and see if there's ways, or go out there, see if there's any options to actually find to expand your business. One option you actually go is that you go to a bank. Of course, when you go to a bank, the bank is going to tell you, all right, well, I need a deposit. I need like a checklist of so and so. And it's going to get pretty expensive, especially when it comes down to insurance. And also you have to go ahead and put a big lump sum of a deposit for this. And it also increases your liabilities. But then you go for a second option. The second option is that you go and as a savvy business person that you are, you go to 10 different private investors, and these 10 private investors, you let them know, hey, look, if you guys are able to go ahead and put in $10,000 each, which we'll call it a $10,000 for a piece of the business, which we'll call a share or a stock, and they agreed. They said, yeah, we will buy a piece of your company. But for the promise of, if your business happens to grow or expand, we will actually like a piece of your earnings. So that's the agreement. So for each of those 10 individual stocks, you are promising to give them a piece of their earnings, and that's what you're receiving. So kind of look at that in a similar way as how a stock works. And also, I just want to add about it could be vice versa, so it could be the other way around. So let's say, because these guys know, the 10 private investors, they know about your company, they know about how high in demand these cookies really are, but let's say that they do invest $10,000 and they happen to notice over time that the business is not doing well as they thought they will. So for that $10,000 that they actually happen to spend on your company, the earnings are not there as it used to be. So the price as they wanted to. So they start losing, and a lot of these some of these investors start panicking, and they basically bail out. They just leave, and which is kind of leaves you with a lower interest of your business. But again, let's say the business is really booming. Let's say it's doing really hot, and there's more investors that want to actually to get involved in your business. So what you do is that, all right, I'll get another 10 more. But instead of charging these guys, or for a piece of your business, $10,000, now you're charging them $12,000. So it keeps on growing, and it actually expands to a nice, successful business. So it's kind of similar to what a stock is, just to kind of give you like a familiar. Of course, there's more technical things when it involves with this stock, but it's just something I just want to go ahead and just add to it. All right, so let's go ahead and talk about what is a index fund. So we'll go ahead and just kind of use the cookie example, what I was actually talking about earlier. An index fund, it's a stocks that are broken into a lot of pieces into a certain basket. So let's go ahead and use our cookie example again. So let's say you go into a cookie store, and this cookie store has 500 options to choose from, which will, for me personally, will be really crazy if you have 500 flavors to choose from. And for me, that would be pretty cool. Yes or no, overwhelming to choose the cookies that I want. But anyhow, let's go get into it. So let's say you go into the store with 500 cookies, and you basically just want them all. But of course, each of these cookies are different priced, and also you basically want to have them all. But of course, each individual cookie costs a different price. And let's say if you only walk in with $100, and of course you're going to be kind of cut short, and you only have a few cookies out there, and probably not the most popular ones. So what ends up happening, let's say these guys, the cookie store had like a package deal, and it's called the index. And this index, we call the S&P 500. And the S&P 500, you actually buy, let's say for $100, you buy a index for $100, and you're able to go ahead and taste every individual 500 cookies. So for all these 500 cookies for $100, you're able to get a little piece, and they actually put into your little basket, and you have 500 cookies. So with that, similar, it's kind of what a index fund is. But in real case, that index is actually compounded with 500 popular companies in the US. And what the index actually follows is a thing called the S&P 500. And I just want to go ahead and note, guys, that with the S&P 500, there's a lot of other mutual funds, and there's subcategories. So of course there's a mutual fund, and there's an actively traded mutual fund. So what the first one is kind of like a passive. And what do I mean by passive is that you're actually able to go ahead and just invest and just leave your money and just kind of let it sit there. But there's another one that's called an actively traded mutual fund. So this one is they actually have a manager. What this manager's responsibility is that he keeps on buying, selling, buying, selling, buying, selling. And one important thing I want to note here, guys, is that of course with the actively and also just the passively, that just a quick note that the passive index fund actually has beaten 95% of these active managers, and also 99% or even 98% of these individual investors. So what do I mean by that? What I mean is that by you investing on, let's say, on an index fund, you are beating most of all these actively, these Wall Street, the guys actually went to Yale or Harvard Business School, or that learn all these finances, and you're actually beating a lot of these majority of the 95 or even 90%, or let's go even 99% of people just by investing on the mutual fund, which is basically what they copy of the S&P 500. A lot of mutual funds copy the S&P 500. And of course there are exchange traded funds, which are ETFs, and they are also similar what a mutual fund is. So with this mutual fund, you're able to go ahead and buy as much. Of course it keeps on tracking, but the ETF, it works a little bit differently. But I don't want to go ahead and get a little bit sidetracked here, guys. Or the main question is, what is better? What is better, a mutual fund or a index fund? Okay, so let's go ahead and just talk about it very quick. Why would people want to go into an index fund? Matter of fact, let's go ahead and just talk about index funds. So with index funds, what their advantage is that they're diversified. So what I mean by diversified, it has like different type of sectors. What I mean by sectors, it could be technology, it could be healthcare, it could be finance. They're all broken down. So there's not one individual sector that it's investing, which, don't get me wrong, there are ETFs or even mutual funds that happen to have only a certain individual sector. There's a lot of mutual funds or ETFs that track a lot of these type of sectors, but just keep in mind that there could be one that just pertains to a certain sector, or this will be ones that has like a mix. You could even invest like an ETF, could even be like a bond, or there's other ones that are even gold, or there's ones that are even oil, and etc. There's just a lot to even think about. So yeah, that's a diversification. So a lot of these mutual funds or even ETFs has that good diversified, so it really helps out, so you're not really stuck to an individual stock. Now the second, what it has is the dividends. Many investors really like the dividends. I personally love dividends. You don't know what the dividend is or how it kind of works. Every time a company or happens to have a lot more revenue, let's say for Apple, for instance, like Apple has a lot of revenue, and the thing is that they have so much money that, yeah, they could go ahead and keep on expanding, but of course they have to limit how much they grow. And so with all this money that is left over, they just don't want to go ahead and let it sit. So what they do is that they start paying you, which is called a dividend, which is a quarterly dividend. And they say, hey, look, if you have $100, for example, if you have $100 on this stock, we'll go ahead and pay you 2% a year, which is called the yield. And they'll pay you out of that $100, they'll pay you $2, which is 100 and 2%. That makes it $2. So they'll pay you $2 per year. Of course, it's going to be breaking down in quarters. So it's going to be like 50 cents per quarter, if I'm not mistaken, or actually not doing my math, but yeah, it is right. So that's kind of what the dividend. So the thing about these index, of course, guys, once again, I don't want to confuse you guys. Index, if you look at index, mutual funds, ETF, same thing, okay? Just think of a basket. Just think of a basket. That's just pretty much what it is. So anyhow, with these dividends, also index funds have them, because a lot of these index funds actually, they buy a lot of individual stocks. So a lot of individual stocks, in my example earlier about how Apple will pay a dividend. So of course, they'll all the stocks in this index funds will happen to buy a little bit of a portion, that will actually pay dividends to the shareholder. And some of these, let's say some of these S&P 500 or some ETFs, some mutual funds will give maybe about like 2% or 1.5% of dividends, which is pretty cool, because over time, I mean, who doesn't like to get paid just to kind of sit back, relax, and just enjoy the good, sweet dividends, you know? I know for sure I do. So let's go ahead and, guys, let's move on to the third one. So the third one is going to be the growth, and that's the thing about the S&P 500. I did a video maybe about a while back ago about how S&P 500 index, that the average happens to grow within 10 to 11% through 50 years actually, and that's kind of what the average has growth. And that's a good thing about it, that even still, let's say, you know, there's been times that we have not have a good market. We'll go back to 2008 or 2009, like even when they actually saw the market crash about 40-50%, or we'll go back to the dot-com bubble back in the early 2000s, when everybody thought that high-tech technology, or actually, the internet stocks were going to be like the next best thing, and so a lot of people start buying into it. So it took maybe a couple of years, or maybe 3-4 years into the market resetting itself. So there's been times, even still, guys, that there's in the market that we look back and some of them will take 10 years to recover. But also, and that's what we call the bear market, but also we have a lot more of a bull market. So we have the bear market and we have the bull market. So the bear markets, of course, that's when they're slowing down and the stocks keep on I will not say keep on dropping, but they still are lower than they used to be on the peak days. But let's say the ones that happen to peak or keep on going up, that's going to be a bull market. And that bull market is just when stocks just keep on going up. As recently as you could tell, back in early 2000 in March until now, it has been, or the time of this recording, it has been going up. But eventually that doesn't always happens to be the case with the growth. You know, there's a thing that happens to, there's a thing actually calls it a reset. It's not like somebody's gonna reset and push a button. No, it does not mean that. It just means that when there's too many investors that are investing in the index fund, of course, that actually creates the value, that growth. Going back to the cookie example earlier, the more people want to invest, you know, the more of your stock it's gonna grow. But does that mean like that all of your 500 companies are doing well? No, actually it does not mean. I mean, there might be about top 10 stocks there that really are make up maybe about 20% of the other 500 companies that you actually happen to buy in the index fund. But the other 490 companies are probably not doing as hot as those 10. But anyway, guys, that's, I don't want to go more detail or anything like that. It just kind of thing is just to think about. Yes, the stock market just keeps on growing, and cool thing about the growth is that even still, if the stock market, let's say for example, happens to crash, as an advantage, or you can actually take advantage of that or actually buy more, because a lot of people will actually go at the exit door, as one of the quotes of Warren Buffett says. When it comes down to market crashes, or people run to the nearest exit, and you should not look at it that way. You should look at it as I don't know, as your store having the biggest discount, and which happens to be the stock market. Probably the best time to be buying versus other people that are selling. So just kind of think about it. Of course, I can't say that all index funds or mutual funds or any ETFs are the same. They're all very different. They all are created different or built in a different way. So you will not. Some of them will stay down for a while. Some will not even grow at all. But you have to really make sure to do your research and to find the ones that are actually going to do well on the long run, and they're pretty diversified. And of course, it might not take maybe a year or two, or maybe it might take 10 years, as history has shown us, till it actually goes up. But as long as you're able to choose the right ETFs, you'll be good. We're going to a fourth one, which is the value. And for the value, let's say, like I was telling you guys earlier, not all index funds are created equal. One of the things you have to go ahead and just check out, that some of these index funds will have a ridiculous sector. So most of them will be heavy invested on a certain investments that they think, and it's called speculation, that they think it's going to keep on going up. But in reality, they're just hoping, just kind of using your money to hope it does. And if it goes up, those kind of makes those guys look like rock stars. But if it doesn't, well, you start losing money. So one of the things I suggest, just gotta look at the value of the index, and also what the index of which companies they actually are investing in. All right, guys. So this actually leads me to the fifth one, risk. And as I was actually talking about the value, the thing about the index funds is that you just got to be careful. Once again, what are they investing in? So when you choose an index fund, you got to make sure what's the sector, because like I said earlier, there's a lot of managers out there that just want to go ahead and invest in particular technology stocks, as history has shown us that when a lot of people just kind of get hyped up and they just want to speculate on the stock just going up or just being hopeful, it doesn't affect them, but it will definitely affect you and your money. So just want to be careful on that. And also too, just to kind of add, guys, just a very quick thing just to know, please, if you are getting a mutual fund or a ETF, a couple of things that just two things, guys, I really need to address to you to check for. First is going to be the expense ratio. What the expense ratio means is just that how much are they charging you. So let's say if you happen to have $10,000 and they charge 1%. So 1% of that $10,000 is going to be about $100, and that's yearly. So that's kind of a little bit too expensive for me. That's something that just kind of watch out. So what you're probably saying, what's probably the best for the expense ratio? Anything under 0.50. But honestly, guys, there's a lot of ETFs or even mutual funds that have a expense ratio that are even 0.15% or even 0.10% or even 0.7%. A lot of Vanguards or even Fidelity have a very low expense ratio, or even Charles Schwab. So definitely one of the things to really look for, guys, because in the long term, if you happen to keep these mutual funds or even ETFs, and they do charge like a very high expense ratio, which is going to affect you in the long run. So just something to really look at. The second is going to be the turnover rate. So I was explaining earlier about the actively managed fund. The manager is going to keep on buying, selling. Those guys are going to go ahead and just buy and sell something that does not see fit to them. So let's say, for example, they happen to buy a stock that they think it's going to be doing super well, that it's going to go all the way to the moon, but it doesn't happen that way. So of course, a lot of them will just speculate just to see what happens, and they start selling it, buying it, selling it, buying it, selling and buying it. So at the long run, what it actually ends up affecting you because the taxes that convert, of course, they're not going to be collecting taxes for you or anything like that, but it's in the end of the year that it's going to automatically come from that fund. Of any earnings they happen to get, it's just going to take it out from it. Definitely look out for the turnover ratio. Normally when you start Googling this kind of stuff, they say about 25% to 20% is kind of the normal turnover ratio, which I still think is still pretty high. I guess that's kind of what the benchmark is, but I've seen some turnover rates are even at 10% or 7%. So anything that I start seeing like at 10% or lower on turnover ratio, it's actually great. Why I say that is because there's really managers out there that really put the hard work, or that don't really switch up these stocks often, just because they research it and they're more into for the long term, and that's what we're here for, is for the long term. Okay, mi gente, let's go ahead and move on. What's the advantages of or disadvantages of getting one individual stock? Now let's go ahead and start out the diversification. Is one individual stock diversified? Obviously it's not. So that's going to be knocking off one point. So let's say, for example, we happen to get Facebook. It is a technology stock, but it does not have another sector into it, like health, or doesn't even have oil or anything like that. Just a brief example. But our index fund does happen to have different type of sectors, which is pretty well diversified. So fortunately, we had to go ahead and take out a point for our individual stock. Now let's go ahead and go with dividends. Now this is actually quite cool, because with individual stocks, there is of course not all stocks have dividends, but the ones they do, they do pay some pretty high, some low. It all depends on which stock you actually happen to get. But of course, guys, I just want to go ahead and just note that if you just only get an individual stock just because it pays a high yield, of course a yield means the dividend, how much they're going to pay you in a percentage per year. Sometimes that's not good if you're only going based by that, because there are some companies out there that love to pay high dividends just to kind of fool you that it's a very attractive business. But what they're doing is that they're using all their capital, which means all their money. These guys are not even growing, they just want to pay more dividends, and those are the ones that most likely will file bankruptcy. But if you end up going into a company that pays dividends or has a very decent track record of paying dividends for the last 30, 40, 50 even years, even we could look back at Johnson & Johnson, those guys have been paying very good dividends. Even McDonald's, that I could think of, been paying pretty good dividends. So some of them even pay to 5, 6, 7%, but of course I have to give it to as well for the individual stock, but you have to be very careful which stock you actually happen to get, because of course not all stocks are equal to to each other. There's are ones that have different accounting. Some are going broke, some are actually making money. So this one I have to call it a tie with the index fund. So let's go ahead and go to the other one. So the growth. This one's another cool one. The thing about this one is that it's one of my favorites, is that with individual stock, it's about the growth. So we know that the index funds sometimes have like this nice steady growth, but also too with the individual stock, it will go both ways with growth or also a decline. And with this individual stock with the growth, if you actually do your homework and happen to really research this individual stock, it can actually grow over time, even more than your index fund. But of course, when it comes down to the safe net, because there's more risk in this individual stock, but I still have to give it towards the index fund. So alright, so let's go ahead and move on to our next one, which is our fourth. Is going to be value. And this is, again, this is one of the biggest advantages or disadvantage that you could have if you're not picking the correct stock or not, because of course there's going to be a lot of research that will come down to it when choosing a stock. But the value, the biggest goal that for us is that we want this nice good value stocks. And also versus with the index fund, there's a lot of, there's like a pretty good handful of the index of those 500 companies. There's a pretty good handful of those companies that are really good value, which are, I guess we'll call it blue chip stocks. They're pretty good companies. But even for yourself though, that let's say if you happen to really put in some time and invest really great, and you get a stock that it's undervalued, meaning that the price of the stock is really low, just because a lot of people have not really researching it as you have, and over time I guess Wall Street will figure it out. It's like, oh wait a minute, hey, this company is doing really great, and Wall Street and everybody starts investing, which is going to really spike up the stock. And of course the value has always been there, but it's going to start putting the stock price where it should be, where where the value of the company is. I guess we call it the book value. But yeah, that's kind of the good thing about the individual stock, is that it's value, depending on how much you do your research. And I think this one, it's a pretty benefit for individual investors, because I think at times if you're doing it correctly, it will grow more than your index fund. So it's one of the things is that just kind of be careful which one you happen to choose. But if you want to put in the safe side, index funds is the way to go. Now let's go ahead and talk to the fifth one. This is the last one. The risk. What is the risk of index fund versus an individual stock? Of course, when we go back to our index fund, it has a diversification. It has decent dividends. The growth is pretty steady, and the value, well, of course, there are some stocks in there that really could really push the index higher. I mean, like as it's this time, if you look at the index fund, the S&P 500 specifically, there's 10 companies in there like Amazon, Netflix, Facebook, that are really pushing this stock really high up. And of course, a lot of the other companies are kind of struggling, especially with this whole pandemic, but they're still able to go ahead and lift up. So that's kind of the beauty of this index fund. So just kind of want to talk about that a little bit. So that's kind of what the cool thing about the value of these index funds is that, or that there's some that have good value and there's some that don't. But the ones that really have value, they're still able to go ahead and still lift the S&P 500 up, which is okay, if you're going back and forth. But when you have 10 companies that kind of pushing forward other 490 companies, yeah, that's I think that's a little bit too big, how 10 companies could really lift that up, raise the growth of the index. But once again, with the risk, guys, when you are choosing correctly and are really doing your research, of course I still have to go ahead and give it to the index, because it has broken down on different sectors that they could invest on, and which you don't really have to worry too much about it. And like I was saying earlier in the video, they're not even the best mutual managers, the one that are actively trading, or even the individual cannot beat 95 to 98 or 99% of people cannot beat the index fund, the S&P 500. So by you just investing by it, that copies it, you're pretty much are just winning. You don't really have too much risk. Of course, there's a thing that there's too many people investing into it, and if it actually happens to crash down, which is still be okay, you still keep on investing as long as the value of the companies are there and things are still doing okay. Why not invest, build? So that's the thing I call that dollar cost average. So as long as your dollar cost averaging, when it does go down, even when it goes down a little bit lower, pull a little bit more. As history has shown, it does go up. But of course, do not blindly just buy it, but also do your research just to make sure that it has value. Versus the individual stocks, on the risk, of course, if the one individual stock doesn't do well, you're just gonna go ahead and just let your stock for that individual business. If it goes down, it's gonna go down. Your money's gonna go down with it. Just as I was kind of giving the cookie example earlier, it's just like a risk. So just I want to go ahead and just give you a heads up on that. All right, so let's go ahead and just recap and just kind of give you my conclusion of what I actually choose. But for as a beginning investor, if someone just happens to go ahead and just begin to invest, I'll definitely recommend is the index fund, the mutual fund or ETFs, anything that will track the S&P 500, and also to look for the two key things, which is the expense ratio, which how much they're going to charge on a yearly basis to hold this fund, and also the turnover rate, just to make sure that these guys are not buying and selling, so the taxes doesn't move on to you. Even though they don't collect it straight from you, but the thing is that they'll take it from the earnings from the index or for the mutual fund or for the ETF. So just something that just kind of beware. But anyhow, guys, I still recommend the index to anybody that's still investing, just because of their growth and also with the less risk. And if you were to ask me what I actually invest in or what I do myself, I actually, in the beginning of last year, on January, I actually started investing. So one of the things is that I put in a lot of course, researching. I put a lot of money on the indexes and anything like that. And when the market did crash, I will not say crash, but when it actually took a big fall, about like a 35% fall by late March or early March, I started putting more money. So like a year later, of course, I have a pretty nice return. But as I've been researching more and more and now trying to go from the indexes, I think I'm able to go ahead and start doing individual stocks. And the thing is too, guys, is that if for you that are new, just go with the index. But for me, it's different because a lot of people out there, they try to go ahead and beat the S&P 500, basically the whole market, which is probably the worst thing you could do. Actually, I tried to do it for quite some time. I was almost successful at a few points, maybe like a 0.04, 0.02 at times, and still staying consistent. But that was pretty ignorant of me, because of course I was thinking the wrong way. I don't want to start beating the index or anything like that. So I have found new ways to actually choose individual stocks that in the long term will help me out, or not even help me out, but will actually grow. So just in case if there's like an index happens to crash or falls another 30-40%, that's okay, still invest, I guess. But for me, I don't want to worry anything about that. I'm investing in individual stocks, and I plan to do it that way, or even have a mix of my portfolio with the index and also some individual stocks. Okay, guys, so if you happen to ask or question or anything like what in mutual funds or even ETFs that I have used, once again, mutual funds and ETFs or index funds. So I'm gonna go ahead and tell you guys what I actually have invested, which have done okay for me, and also in terms of ETFs and index for my family that I suggested, and also I have invested for them or for their behalf. One that I personally have used myself is called the I have it here written, the ticker symbol is the FXIAX. This is a mutual in Fidelity, which is it actually tracks the S&P 500 for those 500 companies, and it has a very low expense ratio. And I think the last time I checked was about like a 0.4% or so. And also the turnover rate was still phenomenal. It was still about like a 10%, which is, I think actually it was 7%, which is still good. And also for my wife, that I actually got for her that has help, is called the SWPPX. It's another one that still tracks, is the S&P 500, and that one has a expense ratio of 2%, which is still really low, really nice. And of course, it's another one that has been tracking the S&P 500. And for the other ones that for ETFs, so let's say if you don't actually have for like a mutual funds or anything like that, I have used iShares, which is actually it's iShares is companies or that actually does ETFs. But anyhow, one of that actually does track the S&P 500 is called is an ETF, so it's called IVV, and this ETF is pretty popular that tracks it. You know, very low expense ratio. Second one is Vanguard, and this one's VU. That's one of the big popular that I actually use for my son. Just in case, I was explaining on another video, if you don't actually happen to have $3,000 to use as an initial investment, VU is probably the best way to actually like a smaller price cost that still tracks the the S&P 500, and of course very low, and it is very popular. Expense ratio is very low, so I mean that's pretty good if you want to kind of start out there. And one that I actually sold recently is called SPY. That's another one, a good one too, that tracks the S&P 500. So that right there, guys, kind of gives the individual, mutual and index funds that I actually have used for myself and my family. And of course, I will not suggest to get them like right now or anything like that, guys, because of course it's pretty high up. So one of the things is that, of course, do your own research. It's on your discretion, but that's something that I have used personally, and it has worked fine for my family. But for example, let's say if the market happens to go down, let's say it happens to go down 10, 15, 20%, of course it'd be the best time. But even still, it's not about timing the market, it's just being in the market. So even if you put in $10, $20, even $100 to buy one of these bad boys, because a lot of these mutual funds, ETFs, depending on your brokerage, because I know Fidelity or even Charles Schwab, they have, or even Robinhood, if you happen to use Robinhood, they do have fractional shares if you want to buy into ETFs only, and just put like 20, 30, 40, 50 bucks, and you still be able to track the S&P 500, which is really good. In terms of individual stock, guys, when the market did hit last year, I bought individual stocks, and mostly were all blue chips like Disney, Facebook. Oh, going back, it's Berkshire Hathaway. It's another one that it's an index, but that's another one that when it actually has went down, has done phenomenal. It's just a great investment. So anyway, guys, that just kind of concludes for this. I know it's kind of a little bit extended, but it all depends what you really want. If you want to grow fast money, for myself, or not fast money, but still long term and safe. Fast money, it's kind of difficult. It comes with more risk. But if you want slower money, at least about 9 to 11% growth over the years, I recommend getting the index fund to kind of grow your wealth over time. But of course, fast money, there's more danger to it. But individual stocks, you really have to do your research. And of course, when you do your research, you're doing well. Yes, you could definitely grow fast and steady, but if you really want to take the slow route, just getting 10%, just let the bad boy compound over time for you just to lay back, I'll go with the index. But hey guys, thank you so much again for listening. I know it's pretty long, lengthy. I'm trying to go ahead and reduce these videos as much as possible. Other than that, thank you very much for listening, and until next time, guys.